Oh, we are live. Hi, everyone. I'm Debbie Schwartz, founder of Road to College and the Paying for College 101 Facebook group. And I'm here tonight with Angela Colatriano of College Ave. So we're just going to wait a few seconds to get people up. I see some eyeballs that are showing up. So thanks, everybody, for watching. Oh, you know what? I'm not seeing. Oh, I got to see my comments. Oh, I wasn't looking at comments. If whoever is starting to watch, we'd love for you to just say hello in the comments. A, it just makes me assured that you can hear and see us. And B, we'd love to know where you're from, how many kids you have, what year your students are in school. I'm assuming a lot of people tonight have a high school senior who is going into college for the first time, but you might have an existing college student. That's fine. So we'd love to know who is out there. So great. I see Roseanne's asking the most asked question, which is perfectly fine. Is this recorded? As we speak, this is being recorded. It sits on the Road to College Facebook page, but we also send out a link to people on our email list. So you can come back and watch it, or if you can't watch the whole thing, you can finish watching it later on. Great. I love seeing everybody commenting. So Angela, if you don't mind, just give ourselves a little background about you and about College Ave.
Sure, I'd be happy to. So Angela Colatriano, I am the Chief Marketing Officer for College Ave Student Loans. We are one of the top private lenders in the country, and we'll talk as we get into this about the difference between federal loans and private loans, but we're one of the top private lenders in the country. We really started this business because we felt like borrowing for college is a necessity for some families and can be a fantastic investment, but can be incredibly stressful. And we felt like we could do it better. And so everything that we've done, from the tools that we've built to the way that we've constructed our products, is designed to try to help take the stress out of the process and give you choices and help you make good decisions.
And you guys should definitely check out, we're going to put some links in the comments throughout the discussion tonight, but check out College Ave's, I hate to say the word blog, but it's your blog or slash website with all really, really good content. And some of the things, if we don't get to a question tonight, we're probably going to put in a link to an article that they have that covers a lot of the questions that you'll probably have. So I love seeing definitely a lot of parents here with high school seniors. It's great with people with some younger students too, like somebody also has a junior, because this is also the perfect time to, even though as a junior in high school, your student doesn't have to take out a loan yet, but it's really so important to start to understand the process and actually factor it in to the college search that you're going to start. So anyhow, anybody who's here with younger students, I commend you, because I love seeing people try and understand this space as early as possible. Okay, so and one last thing before we get started on the different topics, feel free, ask a question in the comment. If I can stop while we're talking to ask your question, I will. If not, we'll try and get to them at the end. So as Angela mentioned, we're going to talk about federal loans and private loans, so that it's important that you understand them both. So maybe, Angela, if you could start and just give like an overview of all the different types of loans, and then we'll get into the details.
Sure. So let's just start comparing federal and private. So federal loans are made directly by the federal government. Private loans are made by a lender or a bank or another private institution. And then there's different flavors underneath both of those sides. So on the federal side, you have the two most common types that students can get are the subsidized loans and the unsubsidized loans. And the unsubsidized are actually the most common loans. And contrary to popular belief, they are not based on need. So they're accessible to a very wide audience, probably virtually everyone who's listening, to this now. And then you also do have loans that are in the parent's name on the federal side, which we will talk a little bit more about. Those are the Parent Plus loans. So before I go on to that, though, I know you've put up some of this information around the subsidized and unsubsidized, Debbie.
Yeah. I mean, you started mentioning it, and everybody should know. And Angela, we'll talk a little bit more about this. But everybody has access to these are called the federal direct loans, or sometimes you'll see the term Stafford loans. And every student who fills out the FAFSA, and that is so important, and we'll probably repeat that many times tonight, has access to one or both of these loans. So it would be, Angela, why don't you kind of go through these two different loans?
Sure. So let's talk about the subsidized first. I'll just sort of start there. So they are based on need. So they are going to be somewhat based on your family's household income as well as the cost of the school that you're applying to. Essentially, the benefit that you get there based on your family or your individual need is that the interest is not charged while the student is in school. So the interest only begins accruing after the student drops below half-time enrollment, graduates, leaves school, essentially, is when the interest starts accruing on the direct subsidized loans. So that's a benefit that families with demonstrated need can take advantage of. And again, the individual school is going to communicate to you if you're going to qualify for that, and if so, what amount you can receive from their school. And then there are also some loan limits that are set by the government. Let's move over to the unsubsidized. That's actually probably where we're going to spend the bulk of our time this evening when we talk about federal loans. They are the most common type. The interest does start accruing immediately when the money is issued to the school, and it will continue to accrue while the student is in school and through the repayment period. These, again, are the ones that they're really not need-based. They are based on where the student is enrolled and are they enrolled at least half-time. And as long as all of those basic eligibility criteria are met, which don't have anything to do with your income, as long as those basic criteria are met, the student is going to be eligible to take that direct unsubsidized loan. And then there are some cases for dependent students, if their parents are ineligible for the PLUS loan, where they can get additional funds through the unsubsidized program. But I would say that the two probably top bullets on direct unsubsidized are probably the most important for the vast majority of people who would be accessing the product.
And this is, again, why I'm just going to emphasize why people say, well, I know I'm not going to get any aid from the college. Why do I need to fill out FAFSA? And I'm pointing at the screen. This is the reason why you and your student need to fill out FAFSA.
Yes. FAFSA is the way you raise your hand and say that you want to be considered. Think of it as the way you raise your hand to be considered for any aid. And it is your access to the direct loans through the government, which if you're going to borrow, if you need to borrow, the direct loans in the student's name, whether they're subsidized or unsubsidized, the direct loans in the student's name are always where you want to start. They're going to be the lowest rates you can get. They're going to be the most common type of loan that a student can get on their own without a cosigner. We'll talk a little more about that. But that's always your first place you want to go if you're going to need to borrow. And the FAFSA is the way that you get access to these loans. I will also just mention that the FAFSA is also the way you raise your hand with schools really to be considered for many types of aid. So some schools won't even consider you for merit aid if you haven't completed the FAFSA, because they consider that the way that you indicate you want to be considered. So number one rule, fill out the FAFSA every year.
So somebody is asking here, Alicia is asking, what's the process to accept these federal subsidized or unsubsidized loans?
You'll actually do it through your school. So when you get your award letter from the school, they will let you know if these are part of your award package, either the subsidized or the unsubsidized, or you may actually have a combination of them. They will let you know if they're a part of your award package, and you will actually work through the school that you're attending to accept the loans.
And then just here's another question, which maybe we can clarify. How do you apply for unsubsidized loans?
Both of them, you fill out the FAFSA. The FAFSA is the way that you raise your hand, and then based on what you've entered in the FAFSA, and again, the cost of the school that you're attending, based on all of those things combined will determine if you qualify for one or both of these products. But the FAFSA is where you go to get access to either or both. Okay.
And one last question, then we'll move on. How and when, if you wanted to start paying interest on these loans, how would you do it?
Yep.
And can you start paying interest on them right away?
You can, and it's a great idea to do it, but you just have to know that you might need to be proactive to find out who your servicer is and find out how much you need to be paying each month to cover that interest as it's accruing, and find out what your payment options are, meaning where do you send a check, or, is there a website you can use? So usually with the federal loans, the payments are not due until the student leaves school. So you just may not necessarily be getting that information as quickly as in terms of how much interest you would need to pay or how to make payments. So you would just need to take that action to contact the servicer, get the information, and then you absolutely could start making those payments immediately.
Okay. So if you guys have more questions about the direct federal loans, and again, these are the loans, quite honestly, if your student needs to borrow, they absolutely should max out these loans first, and we'll talk about what the limits are. But these are probably, particularly as a freshman and sophomore, the only loans that they're going to be able to get without a cosigner. Now, that's a pretty important statement. And it's probably going to be the loans with the lowest interest rates that they're going to be able to find.
Yes.
Okay. So how about, so now we've talked about the student federal loans. I'm going to switch to, I'm going to jump a slide. And do you want to explain the Parent Plus loans?
Sure. So as we mentioned, and as we'll go into more detail in a minute, there are limits to what a student can borrow through the federal program. So you always want to take those first, but there are limits to what the student can borrow. And actually, I will touch on them here, and then maybe we can show this.
Here, do you want me? I can go back. Here.
It might make sense.
Okay.
So as you can see, I would say really focus, again, largely on the dependent undergraduate column. There are situations where a student can be declared independent and can qualify for more. But again, you're talking about less common situations. So
yeah, and so let me just say, we put this on here just because this is the fact, like there's limits for dependent and independent. And then I always get the question, well, how can my student become independent? It is not easy.
It's not easy.
I wouldn't count on it. You got to go to court. It's just, so yeah. we tell you that there's that category, but 95% of students, are going to really be dependent undergraduates.
Yes, most of you want to be focused on that dependent undergraduate column. And as you can see there, as a freshman, most undergraduates can only borrow $5,500 through that direct program. And actually only a subset of that can be subsidized. So $5,500 is really going to be your cap freshman year that any student would be eligible to borrow through the direct program in their own name. So once you've reached those, and you can see that it actually does increase as you go in school, but even once you're a junior or senior, your limit is $7,500 each year that they can borrow on their own through the direct loan program. So there are caps, which are often the reason why parents and families will start to consider either the Parent Plus loan, which is the federal loan in the parent's name that we'll talk about, or they might start to shop private. But let's talk Parent Plus first, so we cover all of our federal options.
Okay.
So the Parent Plus loan, again, once the student has maxed out what they can take in their name, that's when the Plus loan could potentially come into play. And you really do need to be a parent of an undergraduate student. They need to be enrolled at least half time. And the parent is taking on full responsibility for this loan. So the parent needs to be comfortable with this being completely in their name, completely their legal responsibility. The student will not be responsible for the Parent Plus loan. Again, you start the process by submitting the FAFSA. And then as far as the rates and the borrowing limits, so this will enable you to cover up to the cost of attendance. So it will close that gap between what the student can borrow in their name and the cost of attendance that the school has calculated for the student. It does have a higher interest rate though. So the interest rate is not going to be as favorable as what the student gets on the direct loans. And it also has an origination fee, which
I know it's got cut off. Sorry. It's actually important information because it's 4.228 is the origination fee, which is a little hefty.
It is. So essentially the origination fee is going to be calculated as a percentage of what you borrow. So it's going to be 4.2-ish% of what you borrow. and it will actually be rolled into the loan. So you'll repay the fee over the course of time with the loan. And it really does add to the cost. So once you get to the point where you're considering a Parent Plus loan, you want to make sure you're fully factoring in the cost of that loan. And that is often when we also tell people, okay, this is when you want to add private to the mix for your shopping. And at least consider private loans in addition to the Parent Plus loan and have them for comparison.
I'm so sorry. Yes, Deborah just mentioned, and I'm looking at my notes, and I realized I really apologize that we did not update the slide. The rate, the 5.3 rate, was from this past year, and it just changed a few weeks ago. And I have sitting in front of me, but we didn't update the slide. The new rate for the Plus is 6.284. So
I was thinking it looked a little low, but
yeah. 6.284 is the new Parent Plus loan rate. Yeah, I'm going to type it in.
The other thing I would just add, as we are discussing any of these federal loan program details, Debbie, while you're doing that piece, is studentaid.gov is the federal website. That's where you can get all of these details. And particularly if you have one of those more specific situations, which we might not be going into tonight, like the independent undergraduate student, that type of thing, studentaid.gov has everything you could possibly need about the program. So I definitely encourage people to check that out and get all of your additional details there. That is the federal website.
There was a question further up, which I thought is good to comment on. Let me go back. Okay. So I guess we'll get to this, but I just wanted to bring it up. Chris is asking, will you cover getting a loan, a Plus loan or a student loan with the cosign? How do you figure out which is best?
Yes, I think that's actually the perfect launching point, because, we've covered, you start with the FAFSA, you take all of the direct loans in the student's name, and then if you still have a gap, the options that you have on the table are really Parent Plus, a private student loan, which will typically include a cosigner. We'll talk a little more about that. Or there are also private parent loans, which would be very similar, I would say, to Plus, in the sense that the parent is taking on the full responsibility for that loan, but there are a few variations. So I think we've talked about Parent Plus in detail. Let's talk about the student loan with the cosigner.
Okay, I'm sorry, Angela, before we go on, I just want to clarify with people, because they're asking about rates, and I again really apologize for having this incorrect rate here. But Christine is saying, is the rate we typed in, which is 6.284 for the Plus, Parent Plus, is that, and then in addition is the origination fee is 4.228, and that's correct.
Yes. So the interest rate for the loan is the
284. Yeah.
So that's the interest rate on the loan. The 4.2 is the origination fee. So the interest rate will apply for the duration of the loan. The origination fee is a one-time fee that will be calculated based on the amount you're borrowing. So let's say you're taking a $10,000 loan, you're going to pay 4.228% of the $10,000. You're going to pay that as the fee, but only one time. It will be charged one time at the start of the loan when the funds are sent to the school, and it will actually be rolled into the loan. So it's within the balance of your loan.
Right. But just to clarify, Angela said it happens one time, but it's one time for each loan. So if you have to take out a Parent Plus loan multiple years, every time you take out that Parent Plus loan, and this origination fee and the Parent Plus loan rate is going to change every year, but you're going to have some origination fee money that's going to be taken out from whatever the Parent Plus loan is that you borrow that year.
That's right.
Okay.
So it's the interest rate versus the fee. They're both percentages. But hopefully that helped.
Okay. Oops.
Okay.
So we started talking about private loans. So we went through the federal loans, student, Parent Plus loan, and now we're going to talk about the different private loans and then make a comparison or give you an understanding about, why you would want to consider one versus another.
Yes. So let's take that very specific question of why might I want to consider a private student loan over a PLUS loan? There's, I would say, two main factors that we see people consider when they're weighing those options. The first is actually responsibility. So in the case of the private student loan with a cosigner, the parent is, or whomever wants to cosign a loan with the student, is sharing responsibility for the student. So the student has legal responsibility for that loan. With a Parent Plus loan, the student is not legally responsible for that loan. The parent has to be it has to be a parent who takes the loan, and they have to take full responsibility. With the private student loan with the cosigner, it doesn't have to be a parent who cosigned. It just needs to be a credit-worthy adult who can qualify for the loan. And then on top of it, they are sharing that legal responsibility with the student. That is often really the key gate that I see people consider in terms of whether they want to take PLUS versus whether they would prefer to co-sign a private student loan. Beyond that, if you have really strong credit, you might qualify actually for a better rate, especially when you factor that origination fee into the PLUS loan. We actually see some people can get a better deal on the private side co-signing with the student, or on the private parent loan, where again, they may still take full responsibility with the private parent loan, but it's entirely possible that they may actually qualify for a better rate, a better deal on the private side if they have really strong credit. So those, I think, are the factors to consider. One is are you a parent? Can you even take the PLUS loan? If you are and you have the option, who do you want to have responsibility? Who do you want to be legally responsible for the debt? And then finally, what's the credit profile? And is it possible that you would actually get a better deal if you were to shop on the private side? So my recommendation, once you are to the point where you're considering a PLUS loan, you should be shopping all three of these to make your decision. Because
one thing we also maybe didn't gonna clarify enough is that the rate for the Parent Plus loan is fixed. It's fixed, as Angela said, for the life of the loan, but it's the same rate that everybody who is applying for the Parent Plus loan gets. You can have great credit. You're going to get that same rate as somebody who has, less than great credit compared to you. And so, that's why if you're considering the Parent Plus loan at that point, before you make a final decision, you should, for comparison's sake, see what other loans are out there and what the interest rate is that you can get. And, to me, it's all about being a smart consumer, and you want all the information in front of you before you make that final decision.
That's right. It may also, as you are comparing those costs, some of the other differences that you will find on the private side, you may find some other choices. So as Debbie mentioned, the rate on the PLUS loan is always going to be a fixed rate. You will actually have variable rate options on the private side, which, no good or bad, right or wrong. Some people prefer fixed. Some people are open to a variable rate. So again, that can change the offer that you receive, though. And so you may have very different options on the private side that you would want to compare to PLUS. And I think as we hit this point where we're talking about this shopping activity, that if you're debating on PLUS, you should really start shopping on the private side as well, so you can make these comparisons. Just want to highlight here that there are lenders, College Ave is one of them, that offer pre-qualification tools. So you may actually be able to go and, without any impact to your credit, get a sense of whether you're likely to qualify for the private loan and what your rate range might be. So you might not get an exact price, but you will get some idea of where you fall within the broader range and your likelihood to qualify. And it will not have any impact on your credit. So that's an easy way to shop. And then if you do actually decide to apply to multiple lenders on the private side, you really want to do that within a 30-day window. And you want to do it within a 30-day window because I think essentially all of the major credit bureaus at this point understand that you're shopping within a category, and they recognize those multiple inquiries within the 30-day window as shopping within the category. And so essentially it will only count as one inquiry versus multiple, as long as you contain it to the 30-day window. So there's really no harm in shopping. It will only help you be more informed and have more options on the table so that you can really fully compare your choices.
No, absolutely. I mean, that's exactly the advice I give. I get a lot of emails this time of year. People confused, understandably so. And honestly, sometimes people think, oh, well, my only option is the Parent Plus loan. And, that might be what they ultimately decide. But I always say, if you're at that point and you need to borrow money, like in a Parent Plus loan, and you have, decent credit, before you make that decision, just go out and see what your other options are. And, the suggestions that Angela gave to ask for a pre-qualification, so that will kind of narrow the range of what your interest might be. And there's zero harm to your credit score by doing that. And then if you truly are kind of ready to maybe pull the trigger and you want to see the exact interest rate, that's fine too. Just, do it in the limited time frame that we're suggesting, 30 days. You'll get your exact rate, and then you can make a decision, and you'll have all the information in front of you, and then you can truly decide, do you want to go with a private loan at this interest rate, or maybe you still decide to go with the Parent Plus loan, but at least you've gathered all your information.
Yes, and really both types of Plus or a private student loan or a private parent loan, all are really going to give you that access to borrow up to the cost of attendance. So all will give you the ability to close that gap. And in addition, on the private side, you typically don't find origination fees. It's certainly a good thing to double check, because it is to each lender's discretion whether or not they charge that, but it's not common. And so that's one benefit if you are shopping on the private side to bear in mind.
Okay. Maybe, Angela, just touch a little bit on variable rates versus fixed rates in the private loans, and if there are any sort of caps.
Sure. So it's going to vary lender by lender. College Ave does have a cap on our variable rate loans. The one thing that I would sort of food for thought for people is really sit down and do the math and think about a few things. One is, how long do you expect to take to repay the loan? What's the difference between the variable rate and the fixed rate that you're offered at the same time? Because essentially, usually when you get your offer, the variable rate is always going to start lower than the fixed rate you're offered at the same time, because the lender essentially is accepting less risk on the variable rate, because the rate can move with the market and can match essentially what it costs the lender to have that loan outstanding at any given time. And so you want to think about, how long are you going to take to pay back that loan? And what's the amount you're borrowing, and how much would it really likely change? Because I think people tend to imagine that they might see very big swings, and they may see monthly payments that change, $20, $50. And I will just tell you that that's not usually common. That usually for the amounts that people are borrowing for school, you're talking about, pennies, maybe dollars. But you don't actually see huge swings in the monthly payments as the variable rate moves. It's usually moderate changes. And again, if you're someone who is even considering it, you can go back and look at the history. College Ave right now uses LIBOR. You can go back and look at the history of LIBOR and how much it has fluctuated. That may give you some intelligence. And certainly I would also consider, what you think the likelihood is that rates are going to rise and how quickly you think they're going to rise. So those are the factors to keep in mind, and then just your own comfort level with knowing that your rate could fluctuate, how long you think you're going to have that loan, and so how long you're taking the risk of that rate fluctuating, and your comfort level with your monthly payment maybe moving up or down a little bit. But I would say, there is no good or bad, there is no right or wrong, and it's perfectly okay to explore those options and to do the math and see what would work best for you.
Angela, maybe we can just repeat this again, because I think it's an important point. Can you say again, where would somebody go to get this pre-qualification?
So we offer that directly on our website at collegeave.com. If you were to go under any of the products, I do recommend, make sure that you identify, this is sort of specific to ours, but it may be relevant for others as well. Make sure you identify whether you're the student or the cosigner correctly, because the cosigner is the credit is more based on the cosigner. So just make sure that you identify that, but you can go under any of our products and access the pre-qualification tool.
And, I don't know offhand, there might be other lenders that have pre-qualification. You probably, honestly, I mean, there are, but I don't know specifically which ones. And the best thing would just go to each lender's site. And if they have it, it would be pretty clear.
That's right.
Okay, here's an interesting question from Karen. Can you blend Parent Plus and private student loans, or does the gap between federal student and cost of attendance need to come from a single source?
I believe you can do both. I think you just have to indicate to the school. So you just need to make sure that you indicate to the school if you are accepting the plus loan. You just need to make sure you're clear with them
how much you're taking.
That you're accepting.
Right.
That's exactly right. How much you're taking, because then you would go and apply directly with a private lender if you were interested in taking a portion of the loans out on the private side. So I would just say, make sure you're very clear with the school what portion of the plus loan you're interested in taking, if that's the route that you want to go.
Right. And even if you are only taking the plus loan and you're not taking a private loan, you don't have to take the full amount. You can take whatever amount up to the cost of attendance that you need. And
that's right.
I am not knowing your particular situation, but I had a family contact me the other day, and it might also be that in divorce situations, one parent might want to take out the Parent Plus loan and another parent might be taking out a private loan. So you can definitely mix whatever you need to.
Yes.
Okay. Here's another question. First, so Marisol's first student going to college, do you take out loans each year, or do you take out a lump sum to cover all 4 years?
Everybody has this question. I'm so glad you asked it, because honestly, everyone getting started has this question. So you come back each semester or each academic year to re-access the loan. You do not take out a lump sum for all 4 years. And in fact, and that's actually true on the federal side or the private side, by the way, you really return each year and borrow for what you need at that point. And let's pretend that let's just use private as an example. And let's say that you apply for a private loan this summer and you're trying to pay for fall and spring that is coming this next academic year. You can actually borrow for that full time period. You can borrow for that full year. You'll need to come back for the one after that, but you can borrow for that full year. But the money doesn't all go to the school at one time. And I think that's very important for people to understand, because sometimes there's fear that they're overpaying in interest for money that they didn't need yet. And that's not how it works. So you would apply, and during the application process, you'll indicate, are you borrowing just for fall? Are you borrowing for fall and spring? What are you borrowing to cover? And then part of the application process is that once you've applied, you've accepted your terms, you've said you would like to proceed with the loan, we actually send that to the school for certification. And what happens during certification is that the school says, yes, the student is enrolled. Yes, they have unmet need. They have not already reached their cost of attendance with other aid, loans, etc. And then they will also echo back to College Ave or to any lender when they want the money and how they want the money. So it's up to us to get the money to them on the right schedule through their preferred method. And what they would typically do if you borrowed for both fall and spring, let's say you're applying in July and you're borrowing for both fall and spring, what they would typically do is ask us to split it in half. That's just the most common thing that happens. So the school would say, yes, they're enrolled. Yes, they're eligible for this loan. Let's just use 10,000 as a nice round number. Send us 5,000 in September. Send us the next 5,000 in January. And a few things happen there. When we send the money, when we send that first $5,000 in September, you're only paying interest on that 5,000. You're not paying interest on the full 10,000, or you're not being charged interest on the full 10,000. So the interest is only accruing on the money that has actually been spent. The other piece is that if something changes for your spring plans and you say, well, I actually dropped that class, or I got a refund check I wasn't expecting, you don't have to take the full second disbursement. The school could change it. There's ways that you could ensure that you don't overborrow for the second disbursement. So I think sometimes people get worried that A, they're going to take more than they need, or B, they're going to be paying interest that they don't need to pay. And the process is really set up to help you avoid those things. And so it is okay to borrow for fall and spring all at once. But to get back to your original question, yes, you're then going to come back for summer or for the next fall or for the next spring, and you're going to do the process again. And you will also do that with the FAFSA on the federal side. So you will come back every October to do the FAFSA.
That was the exact next question. Yes.
Every year.
Yeah. And the other reason, so you do have to fill out the FAFSA every year, to kind of re-raise your hand and say, you want to take out the federal loans, and quite honestly, you can change your mind. Maybe the first year you took out a Parent Plus loan, the second year you have to borrow beyond your students' federal loans. You may decide at that point that you're going to take a private loan. So you do not have to do the same thing every year. The other reason why you need to reapply every year is, as you saw, the interest rates change. So it truly is a new loan, even though it's for the same purpose. You're going to end up with multiple loans at different rates.
Yeah.
Okay. Here's an interesting question. Oops. Oh, no, sorry. We said that one. I the wrong one. No, I lost. Oh, here it is. Can the loans be refinanced or renegotiated in the future?
Yes. So you can refinance the loans in the future. What I would say is that it's usually once the student has graduated and has established an income and has established their credit. That's usually when it will make sense that you would be able to qualify for an offer that you will say, well, A, that you can qualify, period, to refinance it, and then B, that you would likely have established that credit and income to get an offer that you would say, yes, it makes sense to trade this thing that I had for this new thing, because you will get new terms and a new interest rate and a new repayment plan and that type of thing. So it is definitely possible to refinance, but I would say, I think it's a rational expectation to have in your head, though, that it would probably happen a few years after graduation once the student has established themselves.
Which is also the time when you might, if you were the co-signer, you might be able to come off of being a co-signer.
Yes.
Okay. So Anita has a question. She just wants to confirm, does it make sense to shop every year too for the best rate? And maybe, as we said, can you switch companies that you're using year to year?
You can. And I think any major purchase like this, it makes sense to make sure that you're still getting the best deal for you. The only thing essentially that you will give up, and you may want to factor this in if you get an offer that's really, really close and that you don't see a big difference, is convenience, because you will end up with multiple loans, and it can be easier when they are through one provider, because again, I'll speak for College Ave as an example, but I think this is pretty consistent with the industry. We recognize that people leave school with these multiple loans. And so we try to do things from a servicing perspective to make sure that you're getting one statement with all of your loans listed. You have one due date. You can make individual payments if you want to, but you can almost treat them as one loan, if that makes sense, in terms of keeping your due dates in mind and knowing what your full payment is. So there's a convenience factor, certainly, to having all of your loans at the same place. But that doesn't mean that you shouldn't, shop around and compare, because certainly if you get a much better offer, it could override that convenience, but it is just something to keep in mind.
Okay, one last question, then we're going to talk about some other features that we didn't go into details about. When's the first payment usually due?
So on the federal side, payments typically begin 6 months after the student leaves school. The 6 months is called your grace period. On the private loan side, the grace period can vary. So that's something that is good to double check by lender, because each lender may have a different grace period. On the College Ave side, we have a 6-month grace period for our undergraduate loans, and we have a 9-month grace period for our standard graduate loans. And then some of our specialty products in the graduate space actually have some nuances there, but I'll leave you to the website if you want those details. So 6 months is the most common.
Okay, so let's start talking about, and I'm going to share the screen again so we can go back and pull up about the different features of a loan. Okay, let me go to the next slide. Okay. So these pertain to private loans.
Yes, so these are very specific to private loans. So cosigner release is a big one that we get a lot of questions about. student loans, private student loans are really sort of a unique animal that many other loans that you would see, like a joint mortgage or things along that line. Essentially, if you applied together, it's very difficult to ever be removed from that. Student loans, the lenders do recognize that parents are really signing on, but to help the student get the benefit of that degree. And it is often the student that actually goes on to repay the loan. And so cosigner release is like I said, a relatively unique aspect of the student loan space. And I think there's two pieces that you want to look for if cosigner release is something that you think may be important to you as a consumer and you're shopping private student loans. One is, does the lender offer it? Not all lenders offer a cosigner release. So double check whether or not the lender that you're considering offers it. And then if they do offer it, find out what their terms are and what requirements you're going to have to meet to be approved for the cosigner release. Because in some instances, what you may find is that lenders offer it, but it's essentially at their discretion. So you apply, and then they will determine whether or not you qualify, and you may or may not have a lot of insight into what hurdles you needed to jump in order to qualify. So I will say, I encourage you to check out our policy on College Ave. You will find that we have clearly spelled out, if you do X, Y, and Z, you will be released from this loan. So our criteria is very clearly spelled out so that people do know what they have to do to get there.
And it's a very fair question, in this shopping phase of the different loans. Honestly, after interest rate, to me personally, cosigner release is one of the next most important things to understand. As Angela said, whether the private lender is offering it and what exactly are the terms. It can vary. It could be, 24 months of on-time payments and a certain, income that the student needs to have, or it could be 36 months. So, whatever it is, you just want to know before you make the commitment.
And I would also really encourage everyone to understand that really anywhere that it's offered, it's going to be contingent on good behavior, so to speak. So don't assume that if you co-sign the loan and you thought the student was going to make the payments and now they're not making the payments, that you will qualify for the release, because really any lender is going to be looking for positive repayment history. So that is another important piece, that if you're walking into this assuming that you will take advantage of that benefit, it's even more important to have the conversation with your student about what the expectations are, who's going to make the payments, when they're going to make the payments, and what the repercussions are if those payments aren't made.
Okay. So, and I encourage people, I know that a lot of people have just been through the admissions process, which is a little bit draining, and you may have had spreadsheets for different colleges and all the different, features related to the colleges that your student was considering. But I would encourage you to make a similar type of spreadsheet, especially if you're going to go out and see what type of pre-qualified rates you're going to get or actual rates, and just write it down, down the lender, what the rates and all their features, so you can make a good apples to apples comparison.
Yeah, I think really identify what's important to you. For example, do you intend to potentially use cosigner release to be removed from the loan at some point? Interest rates are an obvious one. You're borrowing money, interest rates matter. It is fairly common that you can get an interest rate discount for automatic payments. So that is one to double check, but make sure you're factoring that into the rate. And then I think two of the other really big ones, especially in the private student loan space, are what are the options to make payments during school, and can you choose how long you take to pay back the loan? So let's start with the payments during school. So we actually offer 4 different repayment options on our loan. You could start making full principal and interest payments immediately. You could pay just the interest each month. You could pay as little as $25 each month while the student is in school, or you can defer and no payments will be due until after school and after that grace period that I mentioned. And we actually incent consumers to try to start making some form of payment while in school, even if it's just $25, because it will save you money in the long run and it gets you into those good payment habits. So we will actually offer a lower interest rate for making that commitment to start making at least some payment during school. I can't tell you that necessarily every single lender works that way, but again, on your comparison chart, you may want to think about, would you be willing to make payments? Would you prefer to make payments? And particularly if you're in that position, make sure you're comparing apples to apples in your offers from different lenders, because, like I said, we would actually offer you a lower interest rate if you're going to make payments during school. And then finally, I think it is that question too of, do they make it easy? I love that the last few sessions, Debbie, I think in the early years, I never heard this. And in the last 2 or 3, people have asked about trying to pay the interest as they go on the federal loans. And I feel like nobody was asking that question before. And it's such a good question. And one of the benefits, I think, on the private side is that we've tried to structure the products to help you see, to help make that easy, to help set you up on a payment plan that can let you come out of school, or let the student come out of school with no accrued interest, because we built it into the product. So, I think that's an important consideration potentially if you're thinking about trying to get a jump on those repayments and not waiting until after school.
And I love, you guys have a tool, right, where you can kind of fool with all of these features. So you can kind of say, well, what would my payments be if I did 5 years to pay it back versus 10 years to pay it back? What would my payments be if I did, 10 years, but I started paying the interest in school? So you can kind of like fool with all these different features and then see how it impacts what the monthly payment is going to be.
Yes, we do. We have 2 different calculators on our website that I would say people might want to check out. One is a more generic calculator. So even if, let's say you already have a loan and you just want to understand what the impact could be on your total cost if you were to start making payments, we have a generic calculator that you can essentially plug any existing loan into and sort of better understand the mechanics of that. If you're actually thinking about borrowing from College Ave, then we have more specific calculators that are designed for our product specifically. So you can see what your choices are on our products. And again, how that choice will affect your payment, your monthly payment during school, your monthly payment after school, and as well as the total cost of the loan, and dial in to really the configuration that's going to work best for you, the choices that will work best for you. And the repayment term is a big one I want to hit, because that is one that is unique. You will not see that choice at every single lender. Some lenders will just assign you the repayment term in terms of how long you're taking to repay the loan. We actually offer 4 choices, so you can take as little as 5 years, as many as 15, and there's a few options in between. And again, we also incentivize you to pick a shorter term with a lower interest rate, because that's in your best interest. You're saving money that way, and so we want to try to.
I was just thinking about that, Angela. Maybe next time. I think it's important for people to understand that. And I have to tell you, I for the like a year or 2, I'm not quite sure I really understood the impact of that. But if you can see, the same person with the same credit score will be offered different interest rates depending on the different features that they choose. And quite honestly, the most basic way to explain it to me is the faster you're willing to pay it back, probably the better interest rate you're going to get, because you're reducing the risk because you're willing to pay it back faster. So.
Exactly right.
Yeah. So it's kind of, we don't have it tonight. I'm going to put it on my notes, maybe like in another presentation. We'll kind of show you how the same person, would be offered different rates, based on these different choices. And so it's kind of interesting to understand. It actually, when you understand, it becomes intuitive. It makes sense.
It does. And once we have the calculators that I described, where you can sort of understand in a very general sense what your choices will be, so you can understand the impact of the choices. And then within our application, when you're approved, you actually get a very similar calculator, but it has your specific interest rates in there. And you're encouraged to essentially play at that point and really find the combination which is going to work best for your budget, and also hopefully keep the cost of this loan as low as you can. So you basically get the tools on both ends. You have it in the shopping experience, and then you actually also have the same thing in the application.
So maybe just also touch on prepayment penalties, because there were some questions about that. If a family was able to pay off the full loan before it was due, is there a penalty?
They're not common. So again, that's something when you're talking, there are none on the federal side. On the private side, it's something that it never hurts to double check, because it is something that each lender has the ability to assign that fee if they want to. but I can tell you that it is not common on private loans to have a prepayment penalty, and we definitely don't have it on College Ave.
So I'm just going to put this up because I so appreciate suggestions like this. Is there a checklist, or will this presentation be available so we can use it when shopping? I love the idea of honestly putting together these questions as like a checklist, because you should be using these types of questions when you look at each lender and loan. So we'll put one together. Okay, so the next kind of big topic, and I see the questions already, is timing. So let's go, and maybe you can talk about when's the right time to apply. How long does this whole process take?
Yes. So the window we're in right now, at least 60 or 90 days before you think you're going to need to have that bill paid, you really want to be starting to shop around. And we also encourage students who might be in that stage of the process to make sure they know who their cosigner is, to make sure that they're having that conversation around who will be joining them at the table. And then for parents, again, you want to be making that call of, do I think I might need to consider plus? If I think I might need to consider plus, then I probably should put private options on the table. And you want to be examining the different lenders, checking out the pre-qualification tools, making your lists of what's important to you and who offers it and who doesn't. And then really within like 30 to 45 days of when that bill is due is when you actually want to sit down and go ahead and do the application. And the reason you want to allow at least that much time, it really comes back to that certification piece of the puzzle that I described, that every application we take, even though we've said we're ready to make this loan, we actually have to send it through that school certification cycle to ensure that the loan will not exceed the cost of attendance, that the student is enrolled, all those good things. And so there's a piece of the puzzle that we don't have full control of the timing, and neither do you. And if you think about how many of these loans schools have to process in a very tight timeline in the summer, you want to try to not leave it to the last minute if you can help it. So I always say, once you know what you need, go ahead and apply, go ahead and get into the queue. Worst case, your school might hold the certification if you haven't registered for all your classes yet, if you haven't finalized your housing decisions, but you are at least in line. If you feel like you need to wait until you have the bill in hand, some people feel they need that to really know exactly how much they need. If you feel like you need to wait for the bill to apply, make sure you've done all your shopping ahead of time, because the schools do not always allow a big window between the receipt of the bill and when the bill is due. Sometimes they're not even 30 days. So you really want to make sure that you've done all your shopping ahead if you're waiting for the bill to apply.
So just a question, maybe we can clarify. Todd's asking, how do you not affect your credit score comparing rates for loans?
So there's two relevant pieces here. I would say the first is use pre-qualification tools when you can, although those won't be guarantees, but they will help you hone in on, am I likely to get this loan, and what kind of rates, might I expect? So pre-qualification is really the only way that you would shop without impacting your credit in any way. That's a soft hit, and you wouldn't impact your credit at all. Once you get to the point of applying, there's really no way to avoid some impact to your credit. But as long as you do your applications within a 30-day window, the bureaus will recognize it as shopping within the same category. And so it will have less of an impact. So they will count that more as one inquiry versus three.
Right.
inquiries.
So if you end up applying to 3 lenders, you're not going to be hit 3 times. Your credit score isn't going to be hit 3 times. Right. It is going to be hit, but it's going to look like, one inquiry as opposed to the multiple inquiries.
That's exactly right. So pre-qual won't affect you at all. Once you apply, it will affect you. So make sure you do your shopping if you're going to apply to multiple, make sure you do it within 30 days.
Okay, so there are some questions here, and actually I have notes of a few things that come up pretty frequently that I realize that maybe we didn't explain enough, and I'm going to roll back a little bit to federal loans, particularly the federal direct loans. And there's this question usually that comes up is, what if my student doesn't take the federal loans the first year? But there was a maximum. Can they double up and take the federal loans, for the first and second year, and all together?
Yeah. So really you are limited to those dollar amounts per year. So if you decline the $5,500 for freshman year, it doesn't mean that you can add it to the $6,500 for sophomore year and take out that full amount. Sophomore year, you're still only going to have access to the $6,500. What it would mean potentially is that if the student goes to school for a 5th year or a 6th year, that you may have additional years where you can access up to that $7,500 limit, which is the higher limit as you get into junior and senior, until you hit that 31,000 cap. There is also a time limit too. It's a calculation. It's something like 150% of the intended time frame for the degree. And the easy way to think about that is that if the student is pursuing a degree, which should take 4 years, they can usually borrow for 6 years, assuming they haven't hit that aggregate cap. So you can't double up, you can't add it on in any individual year. It just may give you the latitude that if you go for more than 4 years, you may have access in year 5 or year 6, but even then you would be capped at $7,500 in each of those years, or less if you've hit the aggregate limit of 31,000.
And, to Angela's comments, it might feel overwhelming, but I do believe that you can sit down now, particularly, for families with high school seniors, going to be freshmen, and you can plan out the 4 years of payments or what the costs are going to be. And you can, I see there are a lot of questions about 529s. When should I use that money? I mean, you can kind of build yourself a spreadsheet, and we actually have a spreadsheet that we can send out for people that you can say, this is what I might get, pay for first year. This is how much loans I'm going to take. I'm going to take out the federal loans, and you can kind of like see it and kind of spread your money out over 4 years, or fool around with how you want to spread your money out. But it would actually be important to try and do that as much as you can, at the beginning. So, you kind of have a plan for all 4 years, and you're not approaching it year to year, which I think, not that it's scary, but you might miss some opportunities of really paying this more efficiently. Mm-hmm. So there was a question further up about a student's credit and taking out a loan, maybe even a federal loan or private loan. How does that impact? Does it help a student build their own credit?
Yes. So taking the loans, assuming that payments are being made on time and the loan is kept in good standing, having these loans will actually help the student build good credit. One thing I do want to note there, because sometimes we hear people say, well, they took a loan freshman year, so now they should be able to borrow by themselves sophomore year because they have a credit score. And it might even be a good credit score because, theoretically the loan is not even in repayment yet. And so that's great. I wouldn't have that expectation. So it takes more than just a good credit score. It's going to, lenders are looking for a history, a depth of file, a variety of credit. They're looking for income, and they're looking for the amount of debt you have versus the income that you're bringing in. And so, yes, student loans can be a jump starter to getting your student to start building their credit profile, but don't operate under the assumption that if they borrow freshman year, they're suddenly going to be eligible to borrow by themselves without a cosigner, just strictly based on that credit that they've started to build.
Okay, good point. How about there's a question that somebody asked, and I also have it in my notes. Maybe just talk a little bit about when somebody actually goes to apply, what type of paperwork or what are they going to need to make sure that they have on hand to actually go through the application process?
So I will tell you the funny thing that I see more often than not. This might seem really obvious, but make sure your student or you have the student's social security number. We often see that students don't know their social security number, or they don't enter it properly, and your social security number is really what's used to match you to that loan, match you to your credit bureau. It is a really important piece of information in the application. So as fundamental as that might seem for some of the folks on this call who have probably applied for auto loans and mortgages and would be very used to the social security number being part of that process, we often find that students don't know it or don't have it. So I would say that's a big one. And then on top of that, you need information about the school. So you do need to know what is the school, you need to know the loan amount, you need to know that academic term. So we talked about Are you borrowing for fall, or are you borrowing for fall and spring? You'll need to make those indications in the application. And then in terms of paperwork, like something that you might actually need to submit other than just filling in those fields online, that can vary from lender to lender. For the most part, I would say there's very little paperwork required for our process. Really, if something should arise, it tends to be around identity verification, just because there are certain federal regulations that we have to meet to say that, yes, we definitely know who's borrowing this loan. So occasionally it may arise that we need a copy of the driver's license or something like that. But from our processing standpoint, there's actually very little and sometimes no paperwork that is actually required. That's going to vary lender by lender, though, on the private side. So I can't promise you that that would be true for every place that you would apply. The social security number will be, though.
That's kind of funny. I mean, this is the big, moment when the 17, 18-year-old has to start to memorize their social security number. Okay, one last question. Somebody is asking, when you do go for pre-qualification, would that actually also tell you that basically you might not even be approved?
Yes, so it could tell you that. And again, even if the pre-qualification says everything looks good, it's not a complete guarantee, because it's just a few fields. It's a high level check. It is not a full application, so it's not a guarantee either way. But yes, it will give you an indication of you're probably eligible, or maybe you're not eligible.
Okay, so Veronica's asking, and maybe you can explain, are there any lenders that don't ask for a cosigner? And maybe you can explain, why a cosigner in this type of loan, is commonplace.
Sure. So I won't tell you that there are not any. There are some that are out there.
But usually not common, and not for freshman or sophomore year.
Not common, and not for freshman or sophomore year.
Oops, sorry.
Because really, at the end of the day, what a lender has to be able to justify is that somebody could make those payments from day one when the money is lent, for sound decision purposes. And the reality is that most students, most of your traditional undergraduates, particularly your freshmen, they don't have any of that evidence. They don't have sufficient income. They don't have a credit history. They don't have anything that a lender could say, it was sound for me to make this loan. I was making this loan on a basis that this individual had the ability to repay it. And so we need a cosigner at the table so that we can justify the soundness of the loan, that there was an individual from day one who had the ability to repay the loan. So students just usually don't have that income and credit history for a lender to be able to meet those requirements. So again, yes, you will. It's not impossible to find that. There are some examples out there, but it is not common. And I would caution anyone who thinks they're going to rely on that. Honestly, it's not easy in the private space to get a private student loan without a cosigner. And
my guess, and I don't, have numbers in front of me, that if it were the case that you could get a loan without a cosigner, and again, it's not very likely at all in freshman and sophomore year, then that loan is also going to come at a higher interest rate compared to if that person was able to have the cosigner.
I would certainly anticipate that, because again, that lender is taking on a significant amount of risk. So I would anticipate that the rate would probably need to reflect that.
So what about, is there any impact if you were a transfer student versus a new undergraduate coming into the process?
No, that's a great question. Actually, there's really no difference from our perspective. We don't even ask that question. We wouldn't even know.
Yeah. Let's see what this question is. Can I automatically take the full amount up to the cost of the school for the Parent Plus, regardless of the number of loans currently taken? This is, so I saw a similar question earlier up, and it kind of relates to if you have multiple students, if you've been taking out loans from your other, like, I'm always, if you've got 3 kids, let's say, and somebody had that example further up in the comments, and you took loans out for your first child, how do you think that starts to impact with, their second and the third child?
So I guess let me answer, I want to make sure I answer their question. On the plus side, having multiple kids or multiple loans is not necessarily going to stop you. I would personally caution you to make sure that because that loan is not going to stop you and not going to say you've borrowed too much, I would say make sure you're doing that math, because it really is down to you to make the right call. They're not necessarily going to stop you from borrowing. On the private side, I will say that it's possible for you to hit aggregate limits if you were co-signing for multiple students over multiple years. It is possible that you eventually max out. And again, it's difficult for me to tell you exactly where you would max out because that's going to depend on your income and your profile. It's not necessarily one set rule for everyone. But I do think, back to Debbie's point around planning, it's not just the 4 years.
It's true.
Maybe 5, right? But
it's actually the multiple children.
It's the multiple children, and it is important to sort of sit down and map some of those things out, because you will have to factor in, I would say, as much about can you still take that debt as should you still take that debt, and what can you safely take on.
Very, very good points. And that's why I'm going to circle this all the way to the beginning. That's why I was so happy seeing some families here that have, high school juniors, because these are the types of analysis that, again, should really be part of, maybe a little bit in the college search, but also at the college decision. When you have offers, you should be happy about the offers, but then you should take those offers and plan them out for 4 years and see what the real cost of going to each of those schools is.
Yeah. And factor it into where you're applying. Make sure you're getting a variety of schools at a variety of cost levels, so you have different choices on the table when your award letters come in. And I would also say, parents, especially for your juniors or your sophomores, if you think that borrowing could be in your future and you might need to co-sign, start now looking at your credit. Is there anything in your credit that's wrong? Is there anything that you could start to repair so that by the time you get to freshman year in college and you might need to co-sign that loan, maybe you've addressed any issues that might be out there that would have prevented you from getting the loan, or might have cost you more.
Such an excellent comment. Again, I had just the other week a mother reach out, and I give her credit because she her student is becoming a rising junior, and she was a little concerned about her credit. And I said, in some ways, this is great. You have a year and you can clean it up. And she was kind of on the cusp, and she could in that time frame improve her credit, which would make a huge difference in, quite honestly, in getting the loans and the total cost of the loan.
The rate. That's exactly right. So great timing for all of you who thought you were early.
Right. Okay. Wow. Well, an hour goes fast. Thank you, Angela. Thank you, College Ave. I hope everybody who watched got a really good education in both the federal loans and the private loans. And I guess what I'm going to say is, if your student is going to be a freshman and you need to borrow, I would say go out and do your research. This is the research time, and gather your information so that you can make a good decision. You still have time. You're not going to feel rushed, but time to start going and checking out lender sites and building your checklist and building your own spreadsheet.
That's right. It's shopping time.
Yep. Okay. Well, thank you, Angela. Thank you, everybody who came to watch.
Thank you, Debbie.
Okay. Bye, guys.